Welcome to the ALX Show, your premier source for DFW real estate data and insights. Let's get to it. Hey guys, welcome back to another episode of the ALX Show. Again, I've got Patrick and Josh both joining us today, and I'm really grateful to have you both here to get your brilliant data-driven minds on what's happening in the real estate market in DFW. And last week was a big shift in the interest rate environment, which will then, of course, impact mortgages and loans in the real estate side. And so on Friday, the Fed announced, or last week, the Fed announced that there's a 50 basis point cut, that they're reducing rates by that much. And so I would love to hear from y'all. What are you seeing as a result of that? And so are you, talking with bankers? What's the data you're seeing? What's happening on the ground in DFW real estate as a result of that cut? And then there's also this really interesting story about a Texas realtor using TikTok. I want to get to that. But first, tell us what's going on in the interest rate world and what the Fed is doing and how that's affecting you guys.
Yeah, it's been a really interesting last week, and mostly interesting in probably thinking through the implications and not necessarily interesting as far as like actual movement in the interest rate world. Bond yields are really largely unchanged from where they were right before the Fed made their decision last Wednesday. You've even had some creep up in the longer term notes and bonds and yield. So the 10-year treasury was, which is what we always talk about as kind of the benchmark rate, was in the 3.5s last Wednesday when the Fed made their announcement. And I think right now is 377 or so. So it's actually increased since the Fed has made that decision, and really shows that that was what the market was expecting. Everyone was anticipating that there'd be a cut of some sort. So there wasn't a ton of future movement. And that's always been a risk that we've discussed, is that your mortgage rate especially is going to be tied most tightly to that 10-year treasury number with a spread over it. And so you probably haven't seen a lot of move if you were getting a mortgage quoted 2 weeks ago versus today. There isn't a great move downward, which if you're not familiar with the financial markets and how they move, could be maybe frustrating or a surprise. So that risk is still there as the yield curve normalizes or continues to steepen with its uninversion, that there will be the risk that the 10-year note could continue to increase in yield a little bit while the Fed funds rate starts to come down, and eventually the Fed funds rate in the 10-year will cross paths again, and Fed funds will be lower than where the 10-year is. The 2-year yield has been pretty steady over the last week, and you can think of that kind of as a proxy for the Fed funds rate and where it's going in the future. And so the market's expecting, a future Fed funds rate really over the next year or two of, call it mid-threes. So that would be another 6 or 7 cuts from where we are today. So that's really what the market's expecting. So that's a big sigh of relief for investors on the commercial side, especially if you've got floating rate loans. I mean, your loan payment became half a point cheaper this month than it was last month. So that's favorable. It isn't probably going to, move the needle a ton cash flow wise for you, but it's, a good start and a sign of things to come. And so like we always say too, is borrowing rates, especially floating rate loans, might not be really cheap still. You're probably still, in the 8% range on a commercial floating rate loan right now. But what it does do is that SOFR futures curve, which is where the index these rates are tied to, as that continues to come down over the next year or so, your cost to hedge your floating interest rate costs through a rate cap or whatever is going to continue to get cheaper. And so that's been the big burden, and probably something we'll talk about from that Wall Street Journal article about rising costs for borrowers. But has been really burdensome is the cost of rate caps. So you've getting through your initial long period here and refinancing is difficult. And so you've got to pony up and come up with funds to buy another rate cap to extend your loan for a year. And those have been astronomically expensive because rates have been so high. So starting to get some relief there too. I think the last I saw was, a generous pricing discount from where we were 2 or 3 weeks ago. So I know that's a long answer, but kind of where we are overall.
Well, I think there's still some confusion. We're still not into the stable credit market. And part of it is because they went 50 basis points. I think there was a lot of questions as to why. And we heard Powell talk about recalibrating. They were just too high given the current conditions, and they kind of wanted to reset. And that makes sense. They want to fend off, a labor market that could be weakening maybe faster than what we even realize. But I think it's still when so many people were expecting a 25. Now, like Patrick said, I think it was priced in that they could go 50, especially in the bond market. But then when they go 50, and some people are still a little bit unsure as to why maybe the economic conditions are maybe worse than what we thought, or is there something underlying that we don't know about? And not to say that there is. I think there are some concerning things within the economy, primarily in the labor market. But when you just don't know, right? As an investor, when you just aren't sure, and then you've also got the election coming up, in 6 weeks, and so there's just some things going on that I think people just need to see a little bit further down the road before they really jump back in and maybe get a little bit more commitment behind their investment decisions. But we'll see that on the mortgage rates. Mortgage rates, they have started to come down. I think they started moving down a while ago in anticipation of the rate cuts, and the 10-year moving down. I mean, everything involved there. But they were 8%, not that long ago, and now they're getting closer to 6%. So we are getting some relief there, and we think they'll get down to 5%. It's all dependent on what the Treasury market does, what that 10-year does, but probably will get down closer to 5% over the course of next year. And I think that's probably a healthy place for them to stay for a while.
Yeah, there was an article that was released from the Dallas Morning News. This was on the 20th, so this was 4 days ago. It said that this is a new chapter in talking about dropping rates, jolting DFW's housing market. And basically what the projection is it'll be maybe next summer before we start to really see a lot of the home sales, pick up where we think, based on these cuts that are coming up. But there is, to some of the other points you were making, so there was a Fed governor that dissented from the rate vote last week. This is Fed Governor Michelle Bowman. And she said just today, this was released this morning, that the rate cut that they had could be interpreted as a premature declaration of victory on our price stability mandate, and talking about we're just not really sure where things will shake out labor market wise, or maybe it was a little too hasty. So she was the lone dissenter there. But to your point, we don't really know how things will play out all the time, but we'll see.
Well, I think you brought up a great point too about maybe looking forward, and like we just talked about, into later next year. One thing to remember is majority of mortgages out there currently are at 5% or under 5% now. So what is it going to take to spur somebody to leave? And it's already close to what they got, because when they got that rate, their home values were also less. So you're getting maybe the same or a slightly worse mortgage rate, and you're going to have to move into a more expensive home, more likely. Yeah. So everyone's situation is a little bit different, but so what's it going to take, and beyond just the normal life circumstances that require a move.
Yeah, that's what we talked about last time. You were like, what would it take for you to move? And I'm like, right. I don't know. My rate at 3.75, like maybe in the 4s is maybe I would start to consider it. But to your point, the houses are more expensive. My house is more expensive than it was when I bought it 2 years ago, and that was just 2 years ago.
Yeah.
So, well, on that point, any other final thoughts on that? By the way, I kind of want to talk about TikTok.
No, I think it's great.
So on that point though, about like home values going up, housing affordability has been something that we've talked about quite a lot. It's such a a growing and important issue that it's even making its way to the presidential campaigns now, that candidates, especially Kamala Harris, is talking a lot about housing affordability, and that there's a current housing shortage. Several million homes, depending on who you read, is a shortage, but particularly in DFW, it's an issue. So there's this article that came out. This is from NBC DFW, and the title is North Texas Real Estate Agent Uses TikTok to Help Renters Find Affordable Apartments. And so there's this young realtor. She's so funny. Her name's Sarah Hamway. She's on TikTok, and she is using that platform to find rental units that are below the median rate. And so the article points out that the Dallas has a median rent of nearly $2,100. But this TikToker, Sarah, she is pointing out several apartments. I think she's got 12 that are under $1,200 a month. And so she was told, you're never going to find anything less than $1,600 a month. But she's like, I can find some decent stuff out there. And this was something we were talking about before we hit record, that the median rent in 2017 in Dallas was $992, and now it's $2,100. So I'm curious what you guys are seeing. Can you validate maybe what this girl's doing on TikTok? Because I think it's hilarious and great. But also, she's striking a nerve of affordability, especially in Dallas. But also that huge shift in just 7 years from $990 to $2,100 median rent, and how that plays into supply and the way that developers are developing units nowadays and things like that. So yeah, what do you guys take of that story?
First of all, I think it's great. I think she's found a real need, and she's out there hustling and finding these apartments for people, just making them aware of what's available, with affordability being such a major issue and putting such a strain, especially on young renters, who I think is her primary audience on TikTok. So I think that she's an example of what a great realtor is. Someone that sees a problem and then goes out and finds a way to solve it. And in this case, just getting the exposure on more affordable units in good areas. I think she talks about it in there. She's not just looking for cheap stuff. She's looking for stuff that's cheaper, but also a nice place to live. So I think she's providing a great service, and it's a good example of what it means to be a good realtor and look out for the people that you're trying to serve.
Awesome.
Yeah, if you look back there was a chart that Freddie Mac put out yesterday of the over the last, looking at it right now, 24 years, undersupply or oversupply of housing, both for purchase and for rent nationwide. And their total shortage estimate right now is way less than what you hear from like the Harris campaign, but it's still a significant number. And if you just kind of overlay the shortage for rent housing with the numbers that you just gave, it's in 2017, the median rent here in DFW was $992 and is now more than double 7 years later. There's something to, obviously supply and demand plays a huge effect, but there's something to reaching a critical mass of undersupply that really starts to, like, demand can no longer keep up and really starts to accelerate. So we started undersupply, a supply shortage, according to Freddie Mac here nationwide in about 2014. And it was a small shortage and then really started to take off in 2017 is when we really started to be short. And that has just continued. And then we've had this construction boom that we're working through. But it's funny that the acceleration in median rent happened at the same time that we really started to get a big supply shortage number. And you've seen the same thing for purchase homes too. Well, when did home values take off and skyrocket? Was 2020. And if you look at this same graph, the for purchase home shortage, which began probably in 2017, 2018, it accelerated rapidly at the beginning of 2020. And so just funny to look back and overlay these numbers with the research that Freddie Mac's putting out, and really paints a nice picture and shows what the need is. is to continue to build more supply and get it out there. And we've got the demand, like we talked about. It's not just demand from people moving in, migration or immigration, but also through new household formation. Like we've talked about roommates decoupling and being able to each go buy or each go rent on their own. And that's still there too, which keeps demand strong beyond just population growth.
I think what you'll see in that chart too is that the housing market got rocked in 2008 to the great financial crisis, and we never recovered. There's right after, like from that point up until it took several years for productivity to get back online and to start to pick up at a pace that was going to be appropriate for the need. And then right when it really started to gain steam, we hit COVID. And COVID shut things down, and then it gets picked up again, but right in the midst of this rate increasing cycle. And for developers and home builders, their rates, their loans are going to be on those short term prime rates. Prime rate, really prime rate is probably most of what you're going to see. Like anytime you go to develop a property, you're going to be getting a loan that's indexed off prime, and that's been around it's 9%, right? It was 8.5. or so, but you're going to get a spread over prime. So, so that makes it expensive. It's expensive to develop. It's already a risky proposition in a lot of cases, and then you throw on a really high debt service throughout the time of the development. That just makes it more difficult. Not to mention there's more regulation. But I'm all for building things in a sustainable, responsible way. But when you put on additional regulations, it slows things down and it makes it more expensive.
Yeah, it's such a trade-off. That's what economists would tell you, of course, about everything. But yeah, if you want houses built a certain way or within certain zoning or whatever, well, that's fine. But it takes longer now to build them. It's more expensive to build them. So now you got the supply shortage, and now you got high rents and all these kind of things that a lot of politicians will propose. But it comes at a cost. Are you willing to bear that cost? That's the trick. But I'm curious if you guys are seeing these kind of developments still to play out, really briefly. Like, how do you see what you just described, Patrick and Josh, what you talked about, just the last 10 years or so, how the market has developed? But do you still see that coming in the next 6 months, especially with the rate cut now that we see and the expected future cuts? Like, how do you see it kind of forming over the next few months, taking shape?
I think we're going to get a better idea as we move in. Like PCE comes out on Friday. It's expected to be low, a good number, like in favor of continuing the rate cutting momentum. But we'll see how the labor market does. I think that's the big concern right now is, once unemployment starts to tick up, it usually ticks up. Starts once it gets a little bit momentum, it typically goes higher and higher and faster. So, and I think that the Fed's just trying to stave that off. So, we'll see kind of what happens there. To me though, it seems based on what the Fed is saying, they're committed to cutting rates. Like Patrick said before, I think the neutral rate is now penciled in at 2.9, around 3%. So we've got a long ways to go from where we are now. But as they cut rates, that's going to be great for short-term lending. Anything that's based on SOFR or prime is really going to benefit from that. What we're really paying attention to is what is it going to do to the longer end of the curve, which is the 10 years, like what we consistently talk about. And I like Patrick mentioned, it has gone up from 3.5 to 3.8 since they made that decision, which I think even though some stuff is priced in, there's some uncertainty. It's still a little bit surprising that it's moved up as much as it has. But I think my prediction is long term it will start to come in as people get more confidence in the movement of inflation continuing to go down and more signaling from the Fed that they're going to continue their path. That I think it comes down probably closer to 3, and then it probably hovers around. Historically, the spread between the Fed funds and the 10-year is what? I mean, it's maybe a point, point and a half. There's not a constant spread, but so if you could expect a point to 2 points above where the Fed funds is, long term, then maybe it's 3 to 3.5 is a pretty good number for the 10-year over the next several years.
You posted a few weeks ago that all eyes are now coming on the labor report that was coming up that Friday. This was 2 weeks ago. Do you still think that all eyes are still going to be directed at the labor market now, given the rate cuts that happened last week?
Yes. I think that is the only thing that can throw a wrench. And people still disagree with me about inflation reaccelerating, but I think the labor market potential deterioration is the biggest risk. I think the Fed was really clear in messaging that too. Because like if you think about it from the perspective of a home builder, you see here now, Freddie's thing says that there's nearly 1 million for purchase home supply shortage here in the nationwide. Like if you think about that as a home builder, as rates start to come down, what you're walking into, man, we've got a ton of runway to eat up a bunch of the supply. Borrowing costs are coming down and home prices are still increasing. Like that, the only thing that can throw a wrench in that is something really bad happening to the consumer. And so I think that the Fed's going to continue to move in support of making sure that the labor market doesn't deteriorate any further. And whether or not they do that, we'll see. But I mean, sentiment's got to be really high for home builders and, people right now. And that's like we said, the best way to alleviate the pressure of affordability is to keep building and building as quickly as we can.
Yep. Well, guys, this is super helpful to give us a sense of like where, we were last week with rate cuts, where we're headed into the future. And as a reminder for anybody listening, you can always check out a lot of this data that I know Josh and Patrick are pulling from. If you go to alxrealestate.com, and you will see an economics indicators up in the top nav, and that will provide a lot of detail about where current rates are across a range of values. I think we have 50 metrics that are on this dashboard and all the links and sources of where you need to go to find this information. But as Josh mentioned last time, the most important thing is that trend. And so seeing the trends in housing supply and labor market, and all that kind of stuff is really helpful. So again, gentlemen, thank you so much. And thank the ALX team for just providing these great resources for the DFW real estate community. And I look forward to hearing back, feedback from listeners or, respond back to the newsletter and let's keep the conversation going because all this stuff is really, really important, especially as we head into the new year and get going into the spring, which is a hot real estate market opportunity. So we will see you all next time.